Imagine converting your entire $1 million IRA to a Roth IRA and later finding out that you overpaid in taxes by six figures for no reason. Roth conversions and Roth IRAs in general are certainly getting all the love online these days, but there are plenty of situations where converting your entire balance to Roth can backfire. And in today's video, I'm going to show you exactly why. For the better part of the last decade, I have helped hundreds of people approach and transition to retirement. And over the past few years especially, I've noticed a growing trend. Many prospective clients are reaching out to me already with plans to convert their pre-tax accounts like 401ks and IRAs completely to Roth to avoid things like RMDs or higher taxes in the future. And while Roth conversions are often beneficial for retirees, there are just as many situations where converting can cost you more money in taxes. So the first reason why you may want to keep some money in those pre-tax accounts is to take advantage of tax deductions in retirement. Whether you take the standard deduction or you itemize your deductions, if your income is low enough and you don't have much other sources of taxable income in retirement like most people do, tax deductions are basically a way to offset the taxable income you receive when you take those withdrawals from the pre-tax accounts. Now, most people will have some other source of taxable income in retirement, whether it be Social Security or pensions, interest or dividends. Let me show you what I mean with a quick example comparing the total tax bill of someone taking a withdrawal from their Roth IRA because they converted everything, and someone taking a small withdrawal from their pre-tax IRA with no other income besides Social Security. So here's a quick example comparing those two scenarios in our tax software here. Scenario one is where they take a withdrawal from their Roth IRA. Again, that's non-taxable because we're assuming that they converted everything to Roth and don't have any pre-tax assets left. The second is where they do keep a balance in their traditional IRA so they can take advantage of their deductions in retirement. So tax year, of course, is 2025 here. They don't have any other wages or salary income. Again, they're retired. And we're also going to keep it really simple and assume no interest or qualified dividends from any taxable brokerage accounts or high yield savings accounts, anything like that. In both scenarios, we're going to assume that they each earn $2,000 per month in Social Security income, which comes out to $48,000 per year. So first, let's look at the Roth IRA scenario. We're going to assume that they take the standard deduction, which is $31,600 for them because one of them is over the age of 65, which means you get an extra $1,600 per taxpayer. So normally it's $30,000 for a married couple, but for them it'll be $31,600. With the Social Security being their only real income, they pay $0 in federal taxes, but they also waste a lot of that standard deduction since none of their Social Security income is taxable. In scenario two, they're able to take a withdrawal from their traditional IRA without paying any taxes of up to $23,000. And the reason for that is because while this does push up their Social Security income into one of those provisional tax brackets, again, your provisional income is going to be your ordinary income like IRA distributions plus half of your Social Security benefit. So about $8,550 of their Social Security is considered taxable, so that's added on to this. But their total taxable income is still less than that standard deduction, so they pay $0 in taxes. So again, the point in showing this is the standard deduction can essentially create a tax-free withdrawal from your traditional IRA if your other income is low enough. A second reason to leave a balance, even if it's small, in a pre-tax account would be to do what's called a qualified charitable distribution, or QCD for short. A QCD is essentially making a donation directly from your traditional or pre-tax IRA to a charity of your choosing. You do have to be at least age 70 and a half in 2025 to do a QCD, and you can do up to $108,000 per year per tax filer. The reason that QCDs are more beneficial from pre-tax IRAs are because neither you nor the charity is going to pay taxes on that money. So if you're charitably inclined, it makes way more sense to send money directly from your pre-tax accounts to charity rather than Roth, because nobody pays taxes on a QCD, whereas donating Roth money means that you already paid taxes on it when you didn't necessarily need to. Once again, this really only makes sense if you're already charitably inclined, because it wouldn't make sense just to give away money to save money on taxes. To do a QCD correctly, remember that you do have to send the money directly from your IRA to the charity. This is usually done as a check made payable to the charity of your choosing. If you withdraw that money to yourself first and then send it to charity, it's not going to count as a QCD and you will likely owe taxes on that withdrawal. It's also important to note that you don't need to itemize your deductions to do a QCD, whereas in most cases, if you donate cash from a regular bank account, you do have to itemize your deductions in order to get the tax benefit from that. So anybody can do a QCD that's over the age of 70 and a half. The next reason why it may not make sense to convert your entire pre-tax balance to Roth is for legacy planning reasons. So if you intend to leave money to the next generation, be it your kids or grandkids or another family member, be mindful of what their income tax bracket is or is expected to be at the time that you pass that on to them. Similar to doing QCDs, it doesn't make sense for you to do a Roth conversion today and pay taxes on that money if your heirs are going to pay a lower tax rate. So just as a quick example, let's say that you are thinking about converting money to Roth so that your heirs can inherit that money tax-free, and you're in the 24% tax bracket today. That would mean $100,000 that you convert from your IRA to a Roth IRA would end up giving them about $76,000, all else equal. If you left that money in a pre-tax IRA for them and they're only in the 12% tax bracket, they could end up with $88,000 instead of $76,000. Obviously, there's other factors that go into this, like the 10-year rule for withdrawing money from a traditional IRA, whereas Roths generally don't follow that rule. I did create a separate video on all the different rules that changed recently for inherited IRAs. Look in the description below this video for that. It's called 7 Steps After You Inherit an IRA. And that leads right into the next reason why you may not want to convert everything to Roth, and that's because you may be converting it in a higher tax bracket today than you're going to be in later. There's a lot of talks about tax brackets needing to increase at some point in the future due to the national deficit. But even if tax rates increase, doesn't mean your personal tax rate will increase. For example, your personal tax rate is dependent on your income in a given year. So if you're converting to Roth today, say in the 24% tax bracket, you only plan to withdraw, say $30,000, $40,000 per year from your IRA, well, that would likely only put you in the 12% tax bracket or so. So again, similar to the legacy planning scenario, be mindful of what your expected tax bracket will be years into the future. One of the most popular reasons for doing Roth conversions that I hear from people that reach out to me are so they can avoid RMDs, which are required minimum distributions. And while RMDs can cause a problem for those retirees that have huge pre-tax balances in those IRAs and 401ks, for a lot of people, RMDs aren't going to be a huge issue. And this is all dependent on your expected balance at RMD age. So what I mean by this is that when you're RMD age, your first year's RMD comes out to about 3.5–4% or so of your balance. So on a $2 million pre-tax IRA, this could lead to RMDs starting at $80,000 and only increasing from there. So that easily could put you into a higher tax bracket unnecessarily. So in that case, yes, Roth conversions may be beneficial. But for retirees that have balances closer to $500,000 or $750,000 or so, a $20,000 to $30,000 RMD may not cause a huge tax bomb that you think it will. Depending on other factors like your other taxable income and what your Social Security benefit is, an RMD may not even change your tax situation at all. So this will definitely require some projections and some return assumptions over time to determine whether or not it is going to be an issue for you. But my point here is don't let the fear of RMDs cause you to convert everything to Roth when it may cost you more taxes today than it would later. By keeping some money in your pre-tax accounts and not converting it all to Roth, it also creates what's called tax diversification. In retirement, you want to have the most control and flexibility as possible over your personal tax liability. Sometimes that means keeping some money in those pre-tax accounts, because over time in retirement, your spending and income tax rate can change from year to year. For example, in the early years of retirement, if you want to make a big purchase, it may make sense to take a withdrawal from that Roth IRA so you're not bumped up into a higher bracket. But in your later years, when you slow down and you're not spending as much, you might be in a lower tax bracket where you can withdraw from those pre-tax accounts. So again, keeping money in those different tax buckets can offer you the most optionality and the most flexibility. And finally, even though I don't think this is likely at the moment, future tax law changes could make Roth accounts less favorable. Under the current tax code, qualified withdrawals from a Roth account are of course tax-free, meaning you have to be at least age 59 and a half and have had the account funded for at least 5 years. There is speculation out there about changing the rules for Roth withdrawals and somehow making the withdrawals partly taxable, whether it be the earnings or subjecting people to a means test. In other words, based on your income, part of those withdrawals could be taxable. If this does become a reality in the future, again, my opinion is that it would only apply to any future Roth conversions as of a certain date and not money that's already been converted to Roth. So that's just my 2 cents on the topic. But if that does become reality, then Roth conversions may not make as much sense as they do today. So as the old saying goes, everything in moderation. Roth conversions are definitely a good way for a lot of retirees to save money in taxes over their lifetime, but you can overdo it. If you're wanting to see how Roth conversions fit into your retirement picture, I do offer a free retirement assessment for anyone considering working with us here at Spark Wealth Advisors. You can click the link below in the description of this video or visit us at sparkwealthadvisors.com/contact to answer a few questions and schedule an appointment to speak with me. Thanks for watching, and we'll see you in the next video.